Hey guys, and welcome to another episode. In this video, we're going to talk about the breaker blocks and how you can use this concept to improve your chart analysis. We will explain what a breaker block is, the psychology behind them, and why they work. Also, how to identify and trade them. So guys, if this is something that interests you, please hit the like button to show your support and subscribe if you're new. See you guys on the other side. Welcome back, guys. First, I just wanted to thank you for helping us reach 100,000 subscribers. The goal of our channel is to share advanced trading knowledge with our audience while respecting their time. None of this would have been possible without your support, feedback, and engagement. So thank you so much for being a part of our community. Now, what is a breaker block? A breaker block is a failed order block that turns into another supply or demand area on the chart. From basic price action, we know that whenever the price breaks through a resistance level, it becomes support due to behavior of market participants. Similarly, whenever the price breaks through a support level, it becomes resistance when market taps into that area again. The same concept applies to the order blocks as well. The market could ignore the order block's supply and demand for many reasons, including a shift in market structure, being overvalued or oversold, tapping into higher timeframe key levels, and more. When a valid demand order block fails to reject the price and the price breaks through, it becomes a supply level. We call it a breaker block, expecting that the market will reject this area. So right here, this is what a bearish scenario might look like. We have a break of structure above this higher high with inefficiency. So this move creates a valid order block zone that can provide us with an opportunity to go long. However, the market makes a change of character, caused by this aggressive move breaking below the previous low. As a result, the directional bias has changed to bearish, and our demand level will turn into supply after this break occurred. The psychology behind the breaker blocks is that the traders who got long in the order block are now trapped after the bearish market structure shift. So, they would want to wait for price to get back to their break-even spot where they can close their longs for no loss. Also, traders will go short here since they see this area as a key area of supply. The outcome of this double action is what makes the price reverse from this area. So one of the key points here is that a breaker block forms when we have a run of liquidity before a market structure shift. The same goes for a bullish scenario. We want to see a liquidity run below the swing low before a market structure shift higher. Then we mark the candles that created inefficiency and extend it in time, which is going to be our breaker block, and we expect the price to reject that area. Here on the Euro-Dollar 15-minute chart, we had a strong bullish move that created inefficiency and broke market structure. As a result, we have a valid order block, which is a great demand level to go long. However, the market suddenly changes direction and breaks below this demand level with large candles. This change in direction could be due to the price tapping into a higher time frame resistance level, as you can see on the 1-hour time frame. But on the 15-minute chart, we see this move as a liquidity grab above the previous highs. We now have a bearish market structure shift, and the area of demand has now turned into supply. Therefore, we expect the price to be rejected from this breaker block and continue to move downwards. Here on the USD CAD 30 minutes time frame, we have identified an order block creating inefficiency and a break of structure. However, the market breaks this demand area, showing a bearish market structure shift. As a result, the demand turns into supply, and if the market taps into this area, it will provide us with a potential short opportunity. Now let's discuss some of the key factors that you need to consider while trading breaker blocks. But first, if you have enjoyed this video so far, don't forget to smash the like button and also comment below and tell us what topics you want us to cover in future videos. Let's continue with the key factors. Number 1. Market structure. You need to identify the current market structure before looking for breaker blocks. Market structure includes defining market direction, supply and demand areas, higher timeframe key levels, liquidity areas, and amount of the space we have in front of the price. Number 2. Validity. Make sure the breaker block you identify is valid. Breaker blocks are created by a run of liquidity before the market structure shift. Look for a sharp move with fair value gaps between the wicks that creates inefficiency. Number 3. Confirmation. Wait for confirmation before entering a trade. Confirmation can be in the form of many price action signals. Here, shrinking candles show that the price is losing momentum while approaching to the breaker block. Then we have a long wick candlestick strongly rejecting the area. Following, we have a change of character, confirming the direction change and signaling a possible reversal. By keeping these factors in mind, you can effectively trade breaker blocks and increase your chances of success. Like with other trading concepts, breaker blocks should be used in combination with other forms of technical analysis to make well-informed trading decisions. For example, here on the New Zealand dollar 1-hour time frame, the market made a bearish change of character by breaking below this swing low. We have this bullish order block turning into supply now, and also this move has created another bearish order block. So either of these supply levels has the potential to reverse the price and make it push downwards, but a more conservative way to enter the market would have been to trade the order block and place our stop above it. Remember that as a trader, our job is not to predict the future but to prepare ourselves for different scenarios that might happen. Now that you understand the basics of the breaker blocks concept, you can proceed with backtesting it on historical data to identify which currency pairs work best with this setup. If it proves to be helpful for your overall analysis, you can add it to your trading strategy. Backtesting is an essential part of validating a trading setup, but unfortunately, it can be time-consuming. That is why we recommend using Trader Edge to backtest and keep track of all your trades. Let me demonstrate how it works. Let's suppose we want to backtest crossover trading setup on the euro-dollar in 1-hour time frame. We will first set up the chart on TradingView and adjust it. Then we will open Trader Edge's backtester and arrange it next to the chart. Here we will input our starting balance and risk per trade, which we've set to 2%. You can change this to any value you prefer, whether in dollars or percentages, for each individual trade. Once we're done with the backtesting, Trader Edge will provide us with a detailed matrix, including important information such as win rate, maximum drawdown, and profit results. It also allows us to save the data and continue adding more backtests, which will all be stored in the strategy library. If you're interested in using Trader Edge, you can sign up for a 7-day free trial by checking the link in the description. So guys, I hope this video provided some value for you. If it did, please hit the like button to show your support and subscribe to our channel if you're new. Also, don't forget to comment below with your thoughts and questions, since we do our best to answer them all. See you in the next episode.